to our video audience and to the audience here in the St. Louis Park City Chambers today. I'm Susanna Dodson. I am the co-chair or vice chair of the Council for Metropolitan Area Leagues of Women Voters, which is fondly known as CMAL. This is our quarterly meeting for the fall. This program is being hosted by the Golden Valley League of Women Voters, and I would like to thank particularly Linda Tallis for her efforts in organizing this event, and also the Golden Valley League of Women Voter President, Marty Mix. So thank you very much to the Golden Valley League for helping with this program. Am I coming over okay on the, okay. I would like to now introduce, well, a couple of comments. The League of Women Voters is a nonpartisan organization devoted to public education and advocating for community participation in the electoral and government process. We do not endorse candidates. The views presented by our speaker are his, and we welcome members, male and female, so consider checking with your local League of Women Voters and of Minnesota, and you will find a league nearby. I'd now like to introduce our speaker today. It's Jay Kiedrowski. Jay is a senior fellow in the Public and Nonprofit Leadership Center at the Humphrey School for Public Affairs. He teaches courses on public and nonprofit financial analysis and budgeting, organizational performance and change, strategic human resources management, integrative leadership, and public service redesign. He also does executive training and consults. With such a busy life, we're very fortunate to have him here. He served as the Minnesota Deputy Commissioner and Commissioner of Finance from 1983 to 1987, and Budget Director for the City of Minneapolis from 1978 to 1982. He's also served as a researcher and committee administrator with the Minnesota State Senate between 1973 and 1977, specializing in tax and urban policy analysis. Our topic today is Taxes 101, what you always wondered but didn't know who to ask. And with that, I will introduce Jay.
Well, thank you, Sue, for that nice introduction. Good morning. Good morning. I can't believe all of you would come out on a beautiful Saturday morning to listen to a presentation about taxes. But thank you for coming. I see there's still one handout. If somebody didn't get a handout, there is one more up here. I made 30 copies. The university is always cognizant of not making too many copies of things so that we don't waste money. So, the topic today is Taxes 101. I was asked to kind of give a primer on taxes, and that's what I intend to do. I'm going to focus solely on Minnesota and its state and local taxes, so we won't deal with the federal situation. So let me just dive in, and feel free to ask questions as we go, or you can wait till the end when we get to that point. So let's start with the type of taxes that are used in Minnesota. There are essentially three different categories of taxation. One is taxing wealth. People believe that it's appropriate that we tax wealth, those people that have wealth. And the way we tax those is through property. Property tax is actually the oldest of all taxes, and it was a view that people that had property were people with wealth, and therefore we should tax the property as a surrogate for taxing wealth. The second wealth tax is the estate tax. When you die, the state of Minnesota taxes your estate beyond a given amount. And again, it's a view that you shouldn't be able to pass on that wealth without paying taxes on that wealth. So again, it's a wealth tax. The second major category of taxation is consumption. So rather than taxing people on the basis of their wealth, it's in fact taxing them on the amount that they consume. And the major way that that's done is through the sales tax. The sales tax is a tax on the consumption that people have of goods in Minnesota. We'll talk about why there isn't a sales tax on services later. There's the use tax. A use tax is for those people really outside of the state of Minnesota that are using services. They pay a use tax. And then there's the excise tax, and the most significant excise tax in Minnesota is the gas tax. So the gas tax is another consumption tax. The more you consume of gasoline, the more you pay in the tax. It's a tax on the basis of a gallon of gasoline. The third category and the last category of taxation is the income tax. The income tax, as the name would imply, is based on the income that one receives. If you don't have income, you don't pay the tax. We have the individual income tax in Minnesota that those people with individual income generally pay. And we have the corporate income tax, which is the tax on business income. Businesses are also covered under the property tax, and they pay sales taxes as well. Obviously, there is no estate tax on corporations, it's just on individuals. So those three are the categories of taxation: wealth, consumption, and income. And you'll see that Minnesota believes strongly in wealth and income taxation and not as much in sales tax or consumption taxation. And that's different than the nation. The nation tends to use the consumption tax more heavily than they do income taxes. So let's just look at the proportions of taxation by those categories, and you'll see that they're about proportional. And this is for total state and local taxes in the state of Minnesota, and it's all taxes, so it would include the gas tax, etc. And you can see that consumption tax is at a third, income tax is at about a third, and property tax is slightly more than a third. This data is as of 2010, but you get a good sense that we have a balanced tax situation. Now, what's a little bit deceiving is that normally when you see a chart like this, it would show the consumption tax being a lot less, and that's because generally it's shown for the general fund, the major fund of state government. And this includes the gas tax, which is in the trunk highway fund, a different fund, but for purposes of this chart, it was all combined. How does taxation differ by category of payer? You can see that Minnesota households pay the primary amount of taxation, almost 2/3, with businesses paying a third exactly, and non-residents paying 3.4%. You say, well, how does a non-resident pay? When they visit, they pay sales taxes. Today, there are a lot of Nebraskans here for the Gopher football game. You saw a lot of red vehicles, unfortunately, driving around. They're paying those sales taxes, those hotel taxes, the liquor taxes, no doubt. And hopefully they'll have to pay more after the Gophers beat them this afternoon. This is a very busy chart, but it's a very important chart, and it shows you Minnesota's revenue situation in 2011 in comparison to the revenue across the entire United States. So what you have at the bottom is the average of all the states, and at the top you have Minnesota. You'll notice that the individual income tax is the largest category, and this is the general revenue sources. So this is Yeah, this is the general, what would be described as the general fund, the major fund for the states. And the income tax is large at 22.4%. It's the largest category other than federal government revenue coming into the state of Minnesota. But the individual income tax is the largest tax. Note that it's quite a bit larger than the sales tax. Corporate income tax is only 3%. It's actually a very small amount. Everybody is always concerned about corporate taxes, but it's actually a very small amount. Other taxes are only 6.7%. These are things like the cigarette tax and liquor taxes collected at the state level. You'll notice that there really isn't a property tax at the state level, and that's characteristic of Minnesota. There's a very small business property tax. It's of a recent, it was recently introduced, and it's small and really insignificant to the story of Minnesota taxes. If you come down and look at the average of taxes across the states, you'll notice the income tax is a lot smaller across the nation, 15.7% versus the 22%. And sales taxes are higher, 14% compared to the 13.9%. This is characteristic of Minnesota. Minnesota has a higher income tax, a lower sales tax. Other states tend to have sales taxes, their largest tax, with the income tax being the smaller tax. And then corporate income taxes, interestingly, a story not often told, are actually higher as a proportion of taxation across the United States than they are in Minnesota. So even though Minnesota has a very high corporate income tax rate, the amount that people actually pay after the apportionment and the deductions is actually quite a bit smaller. The other thing interesting about this chart I found was that user charges are about 23% compared to only 8% in Minnesota. So 23% across the country on average and 8% in Minnesota. And Minnesota has had a philosophy of not wanting to nickel and dime its citizens with all sorts of fees and charges, but they wanted to have people paid generally through income taxes and sales taxes and property taxes in the state. Okay? Yes?
Does Minnesota have perhaps too many corporate deductions to keep that an even tax across
The question is, does Minnesota have too many deductions and adjustments in the corporate tax? And I'll get to that when we look at the corporate tax. We're going to go through each of these taxes individually, but I wanted to give you a feeling for it. And the basic answer is yes. We have a high rate with a lot of deductions. So it ends up that the major corporations in Minnesota really don't mind corporate taxes that much because they're accommodated within that tax structure. Okay, this is looking at, yes, sir.
How do we rank on total tax revenues per capita?
Generally, we are in the top 10 on total taxes. I'm going to show you a table in tax comparisons, but I'll use $1,000 of personal income, and you'll be able to see it that way in a minute. So, good question. Thank you. This is the local government situation. So this is the average of all local governments in the state of Minnesota, again for fiscal year 2011. You'll notice that the property tax is the primary tax at the local level. This is cities, schools, and counties. There is quite a few dollars coming in from the state. This is primarily for schools and money coming in from the federal government. I'm sorry, this is for schools as well as for human services through the counties. Schools receive state aid money, and then the counties receive dollars for human services. It would include local government aid, yes. And you'll notice user fees are used more in local government. These are things like building permits, parking meters, all of those sorts of things. And there is small use of sales tax in certain cities, And then there's the Hennepin County sales tax and the sales tax for transit in the metro counties. If you look at local government in the United States, you'll see that property taxes are even higher as a percent of the total revenues at 29%. They receive less money from state government. Minnesota provides more money from state government to local government than do other states. You see the user charges about the same. So it's not too different, with the exception that more money is provided by the state of Minnesota to its local jurisdictions than does the other states provide to their local jurisdictions. Yes, ma'am.
The one thing you didn't point out was in both the local and the state, that came out from the federal government is considerably lower in Minnesota.
Yes, the 3.5% for federal dollars versus 5%. This is typical. Minnesota, if I remember correctly, ranks 47th in the amount of federal assistance it gets of all the states. We're very low in the amount of federal dollars that we receive. And it's basically because federal dollars are provided most often on the basis of need, and Minnesota is a wealthy state and doesn't have as much need. Therefore, we get less in welfare payments, we get less in things. And then we also don't have a large defense industry within Minnesota, and that's where a lot of the southern states receive a lot of federal dollars. And then the third category where you'd receive a lot would be if you have a lot of federal land. So the western states receive a lot of federal dollars. We don't have that situation in Minnesota generally. Okay, just to show you what a county might look like, I picked Hennepin County, the county that we're in. And this is 2012, and you see taxes are 50% of their revenues. And again, these are primarily property taxes, with Hennepin County being unusual in that it does have a sales tax that's used for the Twins ballpark, along with some library funding and some other funding within that sales tax. And then there's the sales tax for transit that also is part of that taxation. The operating grants and contributions are the money that they get from essentially the state government for human services. And then you can see charges for service is not unlike it was for all of local government. If you look at the city, I wasn't able to get the pie chart on St. Louis Park in a hurry, so I picked Hopkins, a neighboring community. I think indicative. 55% of the taxes for a city are in fact property taxes. They don't receive operating grants and contribution, 19%. Hopkins does receive state aid. Not all communities in Minnesota receive money from the state. It depends again on need, the age of the community, the age of the housing, and other factors are part of that decision making. And here's a category that's important to look at, and that's tax increments. Tax increments are part of a development tool called property tax increment. And what happens is a development is approved, dollars are used, public dollars are used for the public improvements associated with that development. And the way those public dollars are paid back is through the increment of how much the development produces in taxes above and beyond the taxes that had previously been collected on that property. So it's called the tax increment. The extra amount that's being collected is used to pay for those public improvements. So that's tax increment. And fairly typical, the 13%, that's not unusual for particularly older communities. So let me dive into the income tax. I have a simple chart here. You probably have seen this. And I'm sure you're all used to filling it out, or at least having your accountant fill it out. The second page, which I don't show, is the signature page, and that's the all-important one. It is the M1. It's the equivalent of the federal 1040, the federal income tax form. This is the M1, the Minnesota income tax form. And that's my way of introducing the fact that we're going to now talk about Minnesota income taxes. So, Minnesota income tax was created under Floyd B. Olson's leadership during the Depression with graduated rates from 1 to 5% back in 1933. Minnesota began using the federal adjusted gross income in 1961. Federal adjusted gross income, if you think about the 1040 form, it's the last line on the form before you turn it over to the second side. It's your federally adjusted gross income. Today we use the federal taxable income, and what that is, it's on the second page, and it's after your personal deductions and after your after your deductions are made, it produces your federal taxable income. It's the last line before you go to the tax tables. That's the income line. That's the first line on the Minnesota income tax form. So we actually use the federal tax definitions to come up with the first line on the Minnesota form. That's done because it's felt that that's the simplest way to do it. I worked for Governor Perpich a long time ago, and he wanted a one-page Minnesota tax form. In fact, he wanted 3 lines. We never got to 3 lines, but we did get to the one page. And it had been simpler in previous years. It's gotten a little more complicated now. But definition of income, rather than trying to calculate it ourselves, we use the federal definition. The general formula excuse me, for income tax is you take the income, you exclude certain things from that income. For instance, Social Security benefits are excluded. And then you take personal exemptions. You get an exemption for yourself. You get an exemption for children. You get an exemption for a parent if you're the source of income for that parent. You get that personal exemption. And then you have deductions for various things, charitable deductions. You can deduct your taxes paid. You can deduct health care expenses if they're greater than a certain percentage. And after you do all of that, you then calculate the rates. You multiply the number that you get, multiply it by the rates, and then you subtract the credits. So there are credits that are provided after your tax is already calculated. And in some cases there's something called the earned income tax credit, where it could be large enough to offset all of your income taxes. So for those people that are earning very little, they do have a tax calculation, but then their earned income tax credit actually offsets that tax, so they end up paying no individual income taxes. So that's the basic formula for calculating the income tax. There are 2 issues with income taxes that I think are important. One is what definition you use of the federal income tax base. Again, we used to use the adjusted gross income. Now we use the taxable income. We don't have to use the federal tax. A lot of states don't use. They create their own definition, but that's where Minnesota is today. The difficulty with it is when the federal government changes taxes, changes the federal income tax, then Minnesota by definition gets a change in the income tax because we're using that definition of federal taxable income. Okay, so that's the downside of doing that. And then the treatment of income from other states. Governor Dayton had a proposal. He was upset that there are people that reside in Minnesota for part of the year and reside in Florida or Arizona or Texas or someplace else as a way of avoiding income taxes. He wanted to create a snowbird tax of some sort. He wanted to treat income from that was derived by a resident from another state when they were using Minnesota for a greater portion of the year. That failed at this year's legislature, There's also a question of how do you tax income from other states when that income has been taxed in that state. So you may, I do some consulting. Occasionally the consulting is out of Minnesota. I've had to file a New York tax form. I've had to file a Wisconsin tax form in addition. So it's always a question, can you carry that over, and how does that carry over to the Minnesota income tax? Okay. Let me now move to the property tax. The income tax in some ways is the simplest of the taxes. The property tax is the most complicated of the taxes, and it actually is a 2-year cycle to determine your taxes, where on the income tax it's 1 year, it's how much income you make. You determine that on a calendar year basis, and then you end up filing your tax form by April 15th. In this case, the year begins in January. A determination is made about your property values, and by year 2 in May and in October you end up actually paying your taxes. So this is for the city of Minnetonka. I happen to have this graphic. In March you receive notification of your property valuation. How much is your property worth for tax purposes? It's different than the market value for which you would sell your house, and I'll show you how that changes. So the market, or the assessor's value, doesn't include the value of any carpeting or drapes or things like that that might come along with the sale of your home. So it generally is at 85 or 90%, the assessor's value is 85, 90% of the market value that you might sell your home for. In November of that first year, you receive the Truth in Taxation Notice. It shows you what the cities, the schools, the counties, the Metropolitan Council, the Transit Commission, all of those jurisdictions that levy property taxes, you get a statement from Hennepin County telling you what they are planning on levying, and then they have truth in taxation meetings in which you can come and object or agree with the amount of property taxes being proposed for your property. It's really at this point all of the rates are, it's a question of what are the rates that are going to be applied, because at that point your property valuation has already been resolved. If you feel your property isn't valued properly, there is the ability to object to the assessor's valuation. You can take it all the way to the court if you want to. Generally people don't. Generally the assessor wins out in those disputes on the basis of what your property is worth. And then finally, again, the property tax statement. In March you actually receive your property tax statement. That's the one that's got the tear-offs down at the bottom. If you're paying semi-annually, many people do, or it could be that your bank is paying your property taxes on a monthly basis through an escrow account where you have that deducted from either your checking account, and oftentimes that's in accompanying with your mortgage payment. But I'm still one of those people that likes to pay it twice a year, so I get this and I tear off one stub in May and pay by May 15th and send another one out in October 15th to pay my property taxes. Okay, so to bring in a little bit of the complexity of the property taxes, as I indicated, you start with the market value, and then the assessor creates the assessor's value, which is slightly less than the market value. We then have state tax policy, and yes, this is a meat grinder. State tax policy makes all sorts of adjustments to the property tax such that you ultimately get something called tax capacity, and that tax capacity is a derivative of your original market value. And the things that the state does to get to this tax capacity, the first thing Minnesota Constitution allows for, which is unusual, not a lot of states allow this, but allows for different taxation of different classes of property. So they have different property classifications, and the property classification, tax classification for homes is lower than it is for businesses. So businesses pay a greater proportion of the taxes on property than do homeowners. And there are agricultural tax classifications, and there are vacation home tax classifications. So there are, I think it's 14 different tax classifications. We also then in Minnesota had something called the limited market value, and this is, we've had for a period of time, then we didn't have it. And that really was that if you made a major improvement on your home, people felt that that wasn't fair, that you had to immediately pay taxes on that. So the amount of the tax increase was limited to 10% per year increase until you got to the point where you were equal with what should have been the tax on your home during that period. So it's a phase-in of the increase in taxation to allow people to make major improvements on their houses and not be impacted immediately by property taxation. Then there's something called fiscal disparities, which was a creation of the legislature in the late 1960s. And what fiscal disparities does is it takes all of the commercial industrial tax base in all of the cities in the metropolitan area, the 7-county metropolitan area, and it puts all of those into a pool, and you receive the average of the pool rather than receiving the amount of commercial industrial property that's in your city or your county or your school district. And the reason that's done is that the legislature in the 60s wanted to share the commercial industrial tax base with the entire metropolitan area. They didn't want to see communities fighting over commercial industrial development. They wanted that to be shared across all of the jurisdictions. And amazingly, we still have fiscal disparities in 2013, so it's been some 50 years that law has been in place as a disincentive for communities to fight over commercial and industrial property development. Houses are not affected by this, so the actual value of houses in the jurisdiction are what's used for the calculation of taxes in that jurisdiction. And then, as I mentioned, there is a small property tax on businesses in addition to the local jurisdiction taxes on businesses, and that's really used for school aid purposes. There's quite a bit of tax relief provided through the school aid formula of state dollars coming to the local schools to help offset property taxes, and the feeling is that businesses should pay a little bit more of the taxes for schools, and a state property business tax was created, so that's taken off, in a sense, the top. Okay. Here are the classifications that I was talking about on residential and non-homestead properties. Your first $500,000 is taxed at 1%, so you take the assessor's market value and you multiply that by 1% to get the amount of valuation that's going to be taxed. Commercial industrial, or there's also the value over $500,000, which is 1.25%. That used to be 1.5%. It was lowered during the Plenty administration to 1.25%. Commercial industrial you see is at 1.5% and 2%, quite a bit more, but there's a break for small businesses that have lower valuations. Farm homesteads you see are substantially less than either business properties and or residential properties. Farm non-homesteads, so the house, the garage, 1 acre of land is the same as residential for those people living on farm property. Rental is at 1.25%, higher than the home classification, And then seasonal cabins, they have it the same as the home properties. So you can see where they can start differentiating and confusing how in fact taxes are calculated. Minnesota is famous for its property tax relief system. The first one, part of the tax relief system, is the classifications I just spoke about. Those assessment classifications allow tax relief be given to some properties versus other properties. There are deductions from the income tax, so the amount you pay in property taxes is a eligible deduction on your federal taxes, which then gets carried over to as a deduction on your individual Minnesota taxes. There's the homestead credit. Everybody receives a credit on as an offset to their residential property taxes. There are the tax deferrals. There are levy limits. Right now, I don't think there are levy limits in place right now. Levy limits, first of all, a levy limit is the rate of taxation on property taxes. It's called the levy. And limits were put in place by the legislature to limit the amount of increase in that tax rate as a way of holding down property taxes. And it's been a source of great frustration for local government because they're faced with having to finance local government, and they've got a cap on how much they can raise in property taxes. Again, my knowledge is right now there aren't levy limits operating, or if they are, they're not very severe for local jurisdictions because there's not much talk of them. Then there's state aid that's provided. Local government aid is provided. There's also from the insurance premiums, there's money provided for police in the state of Minnesota for police pensions. We have the fiscal disparities that I spoke about. And then there's the property tax refunds. On top of everything else, Minnesota felt that it was important that people of lower income not have to be burdened with high property taxes. So the legislature put in place what was called at the time the circuit breaker. It is a income adjusted property tax relief program. You fill out the forms in April. You send those in, and the state sends the money to you in late August for your relief. And the relief is up to, I think right now it's $1,350 is the maximum offset you can get to your property taxes. So in a sense, the moral of the story in Minnesota is if you're poor, get a really big house because you won't have to pay much in property taxes if you don't have much in income. Of course, the fallacy of that is you're going to have to make your payments on that large house. So that's a bit of a problem. Property tax considerations. I started by saying the property tax was always considered a wealth tax. Is it a wealth tax? If housing is something that we all have to survive, and a cooler day like today sure makes that point, then is it really a wealth tax, or is it simply a tax on consumption, another form of consumption? So there's always a debate about that. Whenever I'm on a boat on Lake Minnetonka looking at some of the multi-million-dollar homes, I get much more comfortable with the property tax as a wealth tax than I do driving around St. Louis Park or some of the other suburban or city communities. The second question is that some people want to call the property tax a local government service fee or a consumption tax. That is, that because you drive on the streets, you ought to pay for the streets, and the property tax is your fee for driving on those streets. And so people would like to make it much more of a user fee, and that would lower the amount that wealthy homeowners or people with large homes would pay in property taxes, and people in lower valued homes would end up paying more in that way. Garbage collection is a service. that is really a fee-based service, and it's directly provided as a fee. There were a few jurisdictions in Minnesota that used to have garbage collection as part of the property tax. Minneapolis, I think, was one of the last ones. They've now gone fully to a service fee, so they've realized that they didn't want to use the property tax in that way. Another issue that always comes up is that there is a whole segment of economics that argues that you should value land, not the property on the land. And people say that you'd see far fewer vacant lots in downtown Minneapolis if you valued the land, because people would want to put the land into productive use. It also would suggest that that land out on Lake Minnetonka would be very highly valued, irrespective of the size of the house on the property. A lot of good, interesting arguments about it. There really hasn't been any state in the United States, and clearly Minnesota has not gone in that direction. But there is a body of thought that argues you should do that. Property taxes are regressive. What regressive means is that the higher your income, the less percent of your income is going to pay for property taxes. And there are those people that feel that taxes should be progressive, meaning that you pay more the more income you have. The property tax is not that way. It is a regressive tax. So there is that debate. And I'll get into regressivity as it relates to the overall tax system in a minute. There are the multiple levies of property taxes, the city, county, schools, metro council, etc. So it's very hard to know when you're paying your property taxes as to how you're holding those local government jurisdictions accountable. When there are so many users of the property tax, it just gets very confusing, where you know the income tax or the sales tax is primarily the state of Minnesota. You know who to complain to. With the property tax having so many jurisdictions using it, it gets to be a lot harder to know exactly who's responsible for that property tax increase. Voting on increases, Minnesota is kind of schizophrenic. At times it says it wants to have voters vote on property tax increases, for instance, on capital improvements in school districts, bonding provisions in school districts. There has to be a referendum. If schools want to have more operating dollars, they have to have a referendum to approve that property tax increase. Yet we allow cities and counties to increase their operating property taxes generally without limits and clearly without a vote of the people. And then tax increment financing can be controversial to the extent that a lot of dollars are deferred or are taken out of the general property tax base and used for development. It means the general property tax base is that much smaller. And there's arguments have been made to limit the amount of tax increment financing that should occur. If you remember, we looked at Hopkins and it was 13%. Some people have said no more than 15% of the total tax base should be involved in tax increment financing. Okay, enough on property taxes. If I haven't confused you by now, I have failed. Kathy.
On that last point.
Yes.
When tax and increment financing is used, eventually the city that used that tool is going to get increased value, as will the state and the county and so on from that property. But during the period that it's in use, aren't the state and county subsidizing the cities that choose to use it?
Yeah, Kathy's question is about tax increment financing, and while cities have the tool to use, isn't it true that the schools and the counties and in fact the state of Minnesota, through its equalization of school aids, school property taxes for schools, aren't they subsidizing that tax increment project? And the answer is yes. And that's why there is now the requirement tax increment has to be reviewed by the counties and the schools, but there isn't veto power. So they have to be reviewed, and that's where some people have argued there should be a cap on the amount of tax increment that's allowed, just for that reason. So, Okay, let's move on to the sales tax. In some ways, the sales tax is the simplest tax. It's levied against eligible items when sold. The sales tax came into use in Minnesota in, wasn't it 1967? If I remember correctly, originally at 3%. The use tax is similar to the sales tax, but applies to purchase of goods from outside the jurisdiction for the storage, use, or consumption in the jurisdiction. So again, it's for people not residing in your area. They come in and they pay a use tax. It's not particularly significant. The excise tax is similar to a sales tax, but it's paid directly by the consumer for things like tobacco, alcohol, motor fuel, and hotel, motel. And it's a way of tying the use of that product directly to the taxation. So, and sales taxes are generally on top of these excise taxes as well. So you pay doubly on those, with the exception of motor fuel. This is a very busy chart, but what it shows you is all the states, and the red is the local sales taxes that are used in the various states, with the blue being the state use of the sales tax. And you see Minnesota right here with a very small use of local sales taxes. Minneapolis, St. Paul, Hennepin County, a few of the metropolitan counties, I think Rochester and Duluth, and that may be it as far as local sales taxes. And those local sales taxes are in 0.25% amounts. So very small use of local sales taxes as compared to Alaska that doesn't have an income tax. So they have a complete use of they have sales taxes locally and no state sales tax. And then you have places like New York that has a very substantial local sales tax as a way of financing local government. And then you have those states that have no sales tax locally, and they generally would use property taxes as a way of financing local government.
Jay, I find this interesting that Florida doesn't have an income tax, and apparently it doesn't have much of a sales tax either. Where does it get its revenue from, or does it not spend?
No, Florida has a state sales tax. The blue is that it has a state sales tax.
Oh, sorry.
The proportion, so they have a very small proportion of local sales tax, but they have huge sales taxes in Florida to get all the tourists, right? And renting cars, just look at the fees on a rental car in Florida to understand their tax policy. Okay, now I want to turn to trying to understand criteria by which we would judge a tax system. And the Tax Study Commission, the last effort to comprehensively look at our tax system was in 1985, back when I was Commissioner of Finance in the state of Minnesota. And remember George Latimer, the former mayor of St. Paul, was the chair of that group. They did really yeoman's work and came up with a set of recommendations on the sales tax. One of the things they said about the sales tax in Minnesota was that it has too narrow a base, meaning that there are too few things that the sales tax applies to compared to other states. And the best example are food and clothing. So many states tax clothing and many states tax food. And the third category is personal services. And more Minnesotans are using personal services, and those do not have a sales tax on them. And the Governor Dayton this year proposed a tax on clothing with a $100 exemption. That is, any clothing above $100 there would have been a sales tax on. and personal services he had proposed a sales tax on. He later withdrew that proposal. It was controversial. The Senate was still interested in the sales tax on services, but in the last compromise that did not occur. But that was one of their recommendations on the sales tax. And their point is that depending on your consumption patterns, some people are going to pay more sales taxes than others, even though, so if you buy a lot of clothes and don't buy a lot of DVDs or stereo equipment, you're going to end up paying proportionately less than somebody that buys those things that has sales tax on it. And they thought that that was inherently unfair. They wanted to include clothing and personal services and not food. Food being viewed as a necessity. Clothing, you can buy cheap clothes and you can buy expensive clothes. And so people, their recommendation is put a sales tax on clothing and you will pick up really how people are consuming in terms of clothing. And they suggested keeping the rates the same and use the additional revenue to reduce other taxes. So their idea was not to raise additional taxes with that sales tax, but in fact to simply lower the sales tax rate. And Governor Dayton proposed both. He proposed lowering the rate some with the increase of the base, but he also said he wanted to use some of it for some of the spending that he proposed in his budget. Okay, let me go on to the corporate tax. Minnesota's corporate income tax was implemented, not surprisingly, in 1933 during the Depression, and I suspect it was packaged with the income tax as, well, if we're going to tax individuals, we better tax businesses, right? It is a small source of revenue for the state. We saw that it's 4.4%. Reliance has decreased since 1980, so we really see that the lobbyists are doing a good job getting more and more deductions or exclusions or apportionments of their income. And what it amounts to is the overall take on the corporate income tax as a percent of overall taxation has been reduced in Minnesota. The Minnesota Tax Study Commission rationale for the corporate tax: it protects the base of the individual income tax. The thinking there was that if you didn't have a business tax, then there would be people that say, well, we shouldn't have an individual income tax either. I'm not overwhelmed with that logic, but that's what they said. The state is entitled to tax all income earned within its borders by residents and non-residents. If you're going to have an income tax, there is a logic that says you ought to tax all income, be it business income or individual income. That, I think, has more logic to it. And then the benefit principle is that businesses benefit from the services provided: a well-educated workforce, well-functioning roads, clean air. They ought to pay for the benefit that they receive through their business taxation. The Minnesota corporate tax structure, again, the federal tax income is used as the basis for taxation, so it's what people pay in their federal taxes, and then with modifications are made. And then the big thing that occurs is that income is apportioned. So you take 12.5% of the property you own within the state, you take 12.5% of the payroll that you pay within the state, and 75% of your sales in the state, and that's the basis for the tax base. So it's heavily weighted to the amount of sales in the state. So if you think about it, this is really helping those corporate headquarters. So the General Mills and the 3Ms and the Targets, all of those, they would pay on property and payroll, but they wouldn't pay on their sales that are worldwide. They only pay on their sales within Minnesota. So they end up paying far less in taxes than if you put it solely on property or solely on payroll. Do you see how that would be the case? So that clearly is one of the features of the corporate tax that makes it better for the Fortune 500 companies that are in Minnesota. You also are allowed to subtract your net operating loss, so it ends up that the corporate tax is a fair tax and that you only pay it if you make it, like the individual income tax. If you make contributions, that's a deduction, so you don't have to pay taxes on the amount of deductions. So you see Minnesota companies being quite good in their contributions. You then compute the regular tax at 9.8%, which again is one of the highest corporate tax rates in the United States. And Governor Dayton, no, that one he didn't want to change. And then there is an alternative minimum tax, as there is on the individual income tax in Minnesota, such to make sure that everybody's paying something, even though they have a lot of these deductions and everything else. But then you are allowed to reduce your ultimate tax bill with some credits. And I'm not an expert on corporate taxes, so don't ask me to recite all the credits. And then is your tax liability. So even though the rate is very high and all businesses like citing the high rate, what people actually pay in Minnesota, as we saw, isn't as significant a problem. And this generally hasn't been raised by the major corporations in Minnesota as a problem. So the corporate tax issues, well, you have the choice of tax base again, and then you have that question of apportionment. Obviously, if you have a lot of sales in Minnesota, you would prefer to see more on property and income or payroll that you pay rather than that. So there is that debate that continues to occur. There are different ways of doing it as well. Again, these are pretty technical issues. You have the rate of taxation. There's been an effort to reduce the rate to get us out of the top 10 in rate. And then there's unitary tax, and that's it's the definition of the corporation versus allowing some of the income that's produced outside of the state to be treated differently. So let me move on to the tax criteria. I want to make sure we get everything in. There are 6 criteria, equity being the first tax criteria by which to judge a tax system. The second one is certainty or predictability. The third one is simplicity, how simple is the system. Neutrality, does it treat all taxpayers the same that make the same? How competitive is Minnesota in its tax system? And is it politically accountable? Do you feel like you can, so like the property tax is one where there's a political accountability problem because you can't really go to the person raising your property taxes very easily. You have to go to multiple jurisdictions, and it's unclear as to who's doing what, and then there's the state coming in and giving aid, and how do you figure out all of that? So in terms of equity, the state every year does a study on tax incidence, and for 2010 they found the personal tax to be positive, which means progressive. So it is progressive, with the state and local sales taxes being regressive to essentially the same amount. Business taxes are slightly less regressive, but they are regressive. All state taxes combined, individual taxes. So if you take all of the taxes, property sales and income for individuals, you'll see it's just slightly regressive. So the notion that Minnesota is a progressive tax state is really shaped by the personal income tax, where in fact it's just slightly regressive when all the taxes are taken together. And these are at the right. And then total taxes, again, are just slightly regressive when you include the local taxes. And this is a prediction for 2015 with changes expected in the Minnesota economy. If the tax system were to stay the same, you'd see it getting slightly less regressive but remaining regressive, with state taxes actually turning to be slightly progressive. Okay? And here is an indication of the progressivity. These are the income levels. So this is the first 10% of income. This is the highest 10% of income. So you see the highest income people in the top 10% pay 10.3% of the total. Interestingly, the people that are the poorest pay 32%. And you say, well, wait a second, didn't you say that the individual income tax, they probably pay nothing? Yes, that's true, and probably don't pay property taxes directly, but pay it maybe through rental. But what they do pay a lot of is the consumption taxes, the sales taxes, a portion of their income. So that's what really hits those lower income people hard, as well as the excise taxes, the cigarette and tobacco and liquor taxes. And you see that, and this is the argument Governor Dayton was making when he said that the income tax needed to be increased for wealthy people, because he thought it was unfair that they would be paying less than a middle income person in the state of Minnesota. You can debate whether that's an appropriate argument or not, but that was at least the governor's argument. And this is 2010, but the data wouldn't be very different except for now the coming year when the income taxes have been increased on the wealthy. That will increase the amount that the wealthy pay. This is the tax by incidence by category, and you see here the sales tax, the great portion of sales tax, and all other taxes that are being paid for by the lowest income people. Again, the next tier, all other are those excise taxes, so it might be gas taxes that they're ending up paying to a great extent. And then over here you have the wealthiest, and you can see how the income tax dominates, with residential property tax being the white bar there, not nearly as significant a portion of income as it is for just about every other tax-paying group. And then you can actually see the top 1%, it gets even skewed a little bit more than the top 10%. Fairness. Fairness is in the eye of the beholder. And so a survey was done of Minnesota taxpayers back in 2003 and 2005. And what they came to find is that the fairest tax, according to the public, is the sales tax. So it's not the most progressive tax, but it's fairest according to our citizenry. And arguably it's because you can choose to pay it or not, whether you want to buy something or not. So you can avoid that taxation. The income tax was considered the next most fair, with the property tax being the least fair of the three major taxes. And I think people, you know, the property tax is just a mess. There's just no other way to say it. And it's really hard to fix. Predictability, this comes from something Tom Stinson did. This may be a little hard to see, but this is gross domestic product. And so when gross domestic product goes from 10% to about 5%, when it varies within that range, wages tend to vary by a greater amount. The corporate tax in Minnesota varies by a whole lot. And then capital gains, these are the individual capital gains, and you see how much they vary. It's this variation in the individual income tax that causes Minnesota to have a very volatile income tax system. And this is what causes the state forecasters great headaches. And this was Tom Stinson, the state economist, who put together this chart, because this was what he pulled his hair out on, was trying to predict when people would cash in on their capital gains. When would they sell their stocks and take the gains, and when wouldn't they? And they wouldn't do it during recession, so you'd end up getting far fewer capital gains. And when times were good, they would in fact cash in on them. And it also relates to stocks options and the capital gains that you pay on stock options. And in good times, people do much more of it. So it just shows you how even though there are small changes in the economy, you get substantial changes in the corporate tax, and in this portion of the income tax, it's really wild. And this is why you get a pattern like this of state deficits, the green being surpluses, the red are all the deficits through 2012. It's because Minnesota's tax system is one of the least predictable, even though we have one of the best, most sophisticated forecasting systems in the United States. We have great people doing it, but the error rate is plus or minus 5%. So our revenues are going to be off either a plus 5% or a minus 5% or a variance range of 10%, which is a lot. Okay. Again, predictability. The property tax, interestingly, is the most predictable. Although for the first time since the Depression, we actually saw home values decrease. That was the first time this Great Recession caused home values to decrease for the first time since the Depression. But still, property taxes are the most stable. The gas tax is the next most stable. Sales tax is in third place. The income tax in fourth place. Corporate tax in fifth place. And the estate tax is the worst. One year, we had a significant Minnesotan die, and that death was noticeable in the tax receipts for the state of Minnesota. It was a $124 million state estate tax that was paid. So, tax simplicity. People again said the sales tax was the easiest to understand. Local property tax they thought was more understandable than the income tax. Okay. I'd like to get them in a classroom and help them a little bit. But it shows your perception is what it is. Tax competitiveness. The gentleman in the back had asked the question about tax competitiveness. Here the measure is not per capita but per $1,000 of personal income, so it's in essence saying of your wealth, how much do you pay in taxes? You can see here the amount of dollars actually paid. Total state and local taxes are $110 per $1,000 of personal income. In 2011, it was $114. It's 108% of the national average. That ranks us as 11th highest in taxes. So generally, we're in that top 10 range. If you look at per capita, it would be slightly higher. Personal income is slightly lower. But what's interesting is to notice that sales taxes were 33rd in the country, so we don't use sales taxes much. The individual income tax, 6th. We end up being 7th when you include local government because we have no local income tax, so we drop a little bit in the ranking. Property tax is 22nd. So you can see that it's really our income tax that drives our tax ranking. Otherwise, we'd be pretty much on average. I created this chart just to give you a sense of who the outliers were. On property taxes, Minnesota is 22nd. This is 2011 data that I was using. Alabama has the lowest property tax ranking of all the states. I then looked at our competitors. Wisconsin's 10th in property taxes, so that idea about crossing the border to get a cheaper house, be careful because it's going to cost you more in property taxes. South Dakota's got lower property taxes. Iowa, slightly higher property taxes than we have. Colorado, higher. So they've chosen a high property tax strategy where Minnesota has not. Sales tax, you can see we're at 33. Wisconsin, it's even less. Sales tax use. South Dakota's pretty high. Iowa, a little higher on sales tax. Colorado, a little higher. Alabama is in that mid-range as well. Income tax, you can see we lead the parade. That's been the ethic in Minnesota ever since the income tax was created. We want to tax through that basis. Wisconsin's 13th. Corporate tax, we're 11th as a percent of personal income. So we do have high corporate taxes even in the amount. It's just not as a proportion of the total. And then in total taxes, we're 11th in the country, Wisconsin actually being slightly higher than we are, in spite of Governor Scott's urging to have Minnesotans come on over and get that great tax climate in Wisconsin. Now, the governor of South Dakota can make that claim. They're 51st in taxation, but don't expect much in services in South Dakota either. Price of government, this is another way of looking at it. This is done by the state every year, and this takes all of state and local taxes and divides by $1,000 of personal income and shows the percent that you're paying out of your paycheck, if you will, out of $1. So in 1994, when Governor Carlson was governor, you were paying 18 cents out of every dollar of your income to state and local government. We reached the bottom in 2009, where about 15 cents of every dollar of your income was going to state and local government, and we're now in that 15.5% to 16% range with the latest tax changes. And the average over that period has been 16.5%. So you can actually see in here the plenty years, but this is also the time of recession. This was the time of the good times, and so that also impacts the ability to tax. Tax level, there's a question about where do you want to do the taxes. In Minnesota, we've done the income tax at the state level, the sales tax we do mainly at the state level, the property tax is mainly at the local level. Other states have made different choices as to how to do the taxation. And the estate tax is solely at the state as well as the gas tax. Wouldn't it be great if there were local gas taxes, so you have to go across the border to get cheaper gas? So in summary, property taxes are the most complex and unpopular, and I say most complex in spite of the fact that citizens think it's as complex as, or not as complex as the income tax. Trying to explain it clearly is more difficult. Sales taxes are narrow and diminishing in importance. In Minnesota, the sales tax keeps dropping as a percent of our total revenues. Sooner or later, we're going to have to do something with that. It's politically difficult because it would be instituting a tax on new things, and people don't like that. The income tax is the most volatile, but in many ways, it's the least noticed. In a group like this, I oftentimes ask, do you know how much you're paying in property taxes? And I get a number of people raising their hands, because generally you know, because you make the double payment, and many of you do, and you know how much you pay in property taxes. I ask about income taxes, and hardly any hands go up. And the reason is it's being withheld, and all you're doing at the end of the year is finding out whether you get a rebate, right, a refund, or you pay a little bit more, but you don't focus very much on how much you paid in total, right? And you never do it as a percent of income, at least I don't. So it is the least noticed of the taxes. And then the corporate tax, everybody loves the corporate tax, but obviously it hurts competitiveness, and the strength of Minnesota's economy is our Fortune 500 companies and their spin-off business that they provide to smaller companies, and so we do have to worry about the size of the corporate tax. So, two final concluding comments. Jim Boyd was a writer with the Star Tribune. He said a diversified revenue structure is important. I think it is. If Commissioner, who's the new revenue commissioner? Myron Franz, if he was here, he'd bring out his stool that has an unbalanced set of legs. It's a three-legged stool and falls over. It's very graphic to demonstrate that we have this problem. I've argued for a long time that we needed a three-legged stool with income, sales, and property taxes equally balanced in the state of Minnesota. Now, I know at the beginning I showed you the slide that showed sales, consumption, and wealth taxes as being equally balanced. But again, that's because of gas taxes that don't go into the general fund. So the general spending in state government really is unbalanced, with the sales tax being the short leg, property tax the larger leg, and income slightly less than property taxes. With that, I stand for questions and love your comments. Yes, Peggy.
I know that Minnesota tries to say, conformance, that wasn't the right word, but we use. the
Conformity.
federal- in conformance with the federal tax calculations. But is there any way that the federal tax calculation can be changed so that a larger proportion of people are actually paying taxes, but still keep the tax burden down lower for those of
Right.
moderate needs?
So the question is, relates to the use of the federal adjusted or taxable income as the basis for Minnesota tax, and is there a way to do that differently such that we could have all Minnesotans paying some portion of the income tax
Or a larger proportion now.
than they are now?
It's kind of scary that
Right.
fewer and fewer people are actually paying
Right.
income tax.
The federal earned income credit is a subtraction after the federal taxable income and the federal tax calculation. And we grab that federal taxable income, so that's prior to the earned income tax credit at the federal level. We bring that to Minnesota, and we then choose to put our own earned income tax credit against that taxable income in Minnesota. What we'd want to do, if you want to make it such that everybody pays a little bit more of income taxes, and some people pay income taxes, then you'd want to reduce that earned income tax credit in Minnesota. The conformity with the federal doesn't affect that.
Well, should the federal be changed? So that.
Well,
in the-
yes.
In effect, throughout the United States, there's a larger proportion of people. who
Yes,
pay
it was Mitt Romney's
a
famous.
small amount.
It was Mitt Romney's famous statement about so many people not paying taxes and not caring. So if you are worried about that, then you would want to reduce the federal earned income credit such that more people had to pay at least some minimal dollars in income taxes. Yes, ma'am.
Oh,
I'm sorry, up there.
No.
Now I have to think about what I was going to say. I was listening. The three-legged stool, I guess, getting back to that. How does one do that and not move into more regressive taxes? Because it seems like the leg that needs to be improved is the sales tax, if that's the effort.
Yes, thank you for the question. The sales tax is slightly regressive. The property tax is the most regressive. So if you increase the sales tax, what a number of people have suggested is that you could have an income tax credit, say for $50 or $100 for people of lower income, so as to avoid the problems of the regressivity of the sales tax. So people have thought about doing that. Governor Dayton's approach to it was to simply exempt anything less than $100 to the sales tax. I don't like that approach because you can buy some pretty expensive socks for $60, and I think you ought to pay sales taxes on that if you're going to tax clothing. But the alternate way is to have an income tax credit for some portion of the sales tax that you pay, and that helps with it reduces the regressivity of the sales tax. Yes, there was back there.
Joanne Brown, Crystal New Hope. Essentially, that was my question as well.
Oh.
However, I did want to just refer to that one chart you had with Minnesota state and local tax equity,
Yes.
where you showed that people in the lowest income bracket are really paying a huge percentage in sales tax. So when you start thinking about things like those taxes, and then you consider, well, maybe everybody should pay some income tax, how do you square all of that? They're already paying lots of tax in proportion to their income.
Yeah, it's a difficult issue. No doubt. That's why we pay the legislature and the governor those big bucks. They have to sort through that. There are questions of equity. And on the other hand, you have to worry about the other 90% of the population too, not just that lower 10%. You need to worry about what's happening in the middle point. And I see a number of people with graying hair in the audience. I say this to all audiences, so I'll say it to you as well, and that's that one of the problems Minnesota faces with an aging population is that the seniors aren't going to have income where they normally would pay taxes. They may have property taxes, but the sales tax, particularly on personal services, will be one of the few ways of taxing seniors to get some income from seniors as part of the total tax system. So, just a point. Yes?
In the political season, you hear so much about people saying Minnesota is so tax unfriendly and it's an unhealthy business climate and the corporations are going to flee. And I mean, what is, from the academic side, what's the truth of the matter? I mean, what's our national personality, from people outside looking in? I mean, I know we're the best of everything, but what do the other people in other 49 states actually, or the business community, what do they really think of us?
Boy, you ask a very difficult question. There's so many different ways of answering it. I showed you some of the data, and you can see that we are a high tax state. We're also a high service state. One of the things that businesses will tell you when you can pull them aside and maybe have a drink with them is that what they're really concerned about is getting qualified workers. And it's hard to attract qualified workers to Minnesota. There's the perception that it snows in the summer in Minnesota, and there's a perception that it's a high tax state. Interestingly, though, once people come here, they tend not to leave. There's been a recent study done. In fact, it's going to be made into a book by a professor at the university. I had the privilege of hearing him make the presentation, that Minnesota, wealthier individuals with children at home are least likely to leave Minnesota than any other states people would want to leave. And what that's saying is that once you get them here and once you get them into our schools, people just do not want to leave Minnesota. They have found what we so enjoy about Minnesota. And so that's why you're not seeing a lot of businesses actually leaving Minnesota. You're not seeing a lot of key executives leaving Minnesota because they, in fact, once they get here, they find it to be really a good place. Now, having said that, it's always a balancing act. And what's the tipping point where General Mills says, we've had enough, we're going to move our corporate headquarters someplace else? You don't want to get to that tipping point. That would be really harmful for Minnesota. And you also want to make sure the dollars that are being spent wisely so that we're providing productive and effective services for those dollars. So I think the story is that we are a high tax state, we are a high service state. Our job growth continues to be better than the nation. The really funny thing about the dispute with Governor Walker over in Wisconsin is that our growth rate of jobs is substantially higher than Wisconsin's right now. The only one we trail in the surrounding states is North Dakota because of the oil boom. So we continue to outperform South Dakota with its low taxes. So if taxes were the only consideration, South Dakota would be booming, and it's not. There's a whole lot of other things, including good education and the civility of the people and the cultural arts and everything else. So hopefully that responds to your question. Sure.
I'm Geneva McMillan from MEF, and I have heard many years about a flat tax. And I would like to understand a little bit more about it. If you could enlighten us, I'd appreciate that. Thank you.
Sure. In Minnesota's income tax, the rates are from 0, some people don't pay anything, to now over 9%. And at various incomes, you pay somewhere in that range of 0 to 9%, okay? A flat tax would have you pay, all income levels would pay one rate, say 4.5% or 4%. So everybody would pay 4%, rather than pay higher earning people paying a higher percent. What the flat tax does is make the tax, the income tax, a regressive tax, so that your higher income people are paying less as a percent of their income than our lower income people when you have a flat tax. So a flat tax idea has not been particularly popular in Minnesota. The popularity is frankly in southern states and in some of the more conservative states, where they would prefer to see rich people paying less in taxes and poorer people paying more in taxes.
I thought a critical part of that, though, was that in creating a flat tax, along with that would have to come the elimination of most, if not all, deductions, so that you couldn't take off, let's say, for big charitable contributions or
Right.
something else.
Right.
Some other kind of tax.
Often coupled with the flat tax is the notion of eliminating all the deductions and credits. So all you do is take your income and apply that tax rate. It doesn't have to be that way. You could still have all those deductions and the credits, but simply have a single rate rather than the graduated set of rates on the income tax. But again, what it does is lead to regressivity in what otherwise today is a progressive tax.
This might be a bit of a narrow question, but you seem to be in a good position to answer it. My understanding from the last tax go-around in Minnesota was that one of the key reasons that the sales tax expansion was turned away from was because our proposal, or the Minnesota proposal, included a tax on business services, not just personal services. And consultants who work outside the state felt that that was a big issue. Is that a big deal, or was that just an excuse?
It is Minnesota would have become the first, or would have become the fifth state in the United States that taxes business services. And given that we are the metropolitan area is a service center that provides a lot of legal, accounting, technology services to the broader region and frankly the U.S., there was a lot of concern in the business community that this would be detrimental. Governor Dayton introduced that business tax as a way of saying if we're going to increase sales taxes on individuals, we ought to increase them on businesses as well. You don't have to propose that. You could not do anything with business taxes and simply increase the base of sales taxes to include clothing and personal services. You could also include food, as some states do, but I think Minnesotans wouldn't want food included in that category. Any other questions?
Well,
Yes.
Okay, exactly what is the personal services that are taxed?
Personal services today aren't taxed, so things like haircuts, oil changes, those kinds of things. When you get your cuffs hemmed, that's a personal service.
And if there are some bizarre inconsistencies, I don't know
Yes.
if that's unique to Minnesota. For instance, if you have someone do your lawn care or your gardening,
That's
you pay a
taxed.
sales tax on that service. But if you have somebody come in and landscape your yard, you don't.
Right. Right. And you'll also notice sometimes at the grocery store at checkout, there will be a sales tax applied to certain items of your food purchases. I think pop has got a sales tax on it. And then some of the products, you might buy, toothbrush, I don't know for specifically, but some products like that aren't food oriented will be taxed at the cash register. So, yes, ma'am.
Does
Minnesota have a plan, I know what you said about the seniors, for covering the change with seniors having less income and needing more services?
And the two things. One is that I made the argument that we ought to tax the seniors, and next year I'll be a senior, so it's not, not with some forethought. But it's an example of how our tax system isn't fairly taxing everybody because certain things aren't being taxed that logically should be. Again, if you're concerned about the impact it would have on certain citizens, you could have an income tax deduction or credit. You could have a credit on the income tax for a portion of that sales tax or all of the sales tax that people pay to make it fairer. But the thing about Minnesota is we're going to feel good because as the economy keeps getting better, our revenues are going to look better and better, and we're going to say, hey, things are great in Minnesota. Well, it's just masking the real problem that's there, and we've got this volatile system. And when people don't end up getting their stock options or cashing in on them, and they don't cash in on their stock gains, our income taxes drop precipitously more than they would otherwise, and that's when we get into the big deficits at the legislature, and they will occur. I was Commissioner of Finance from 1985 to 1987, and at that time I said, this is the problem. And look, it's 2013, we've got the identical problem. Nothing has really changed in the characterization, or the composition rather, of the tax system to change that.
One last question.
I didn't know if I heard you right, but did you say that Social Security income is not taxed in Minnesota?
I don't know specifically.
Okay, thank you.
Sorry.
Okay. I thank you, Jay, for your comments and information, and we have a lot to digest, and I think we should give a big hand. On behalf of the League of Women Voters, the CMAL, Council for Metropolitan Area Leagues of Women Voters, and Golden Valley League of Women Voters, I'd like to thank everyone who's attended and who is listening to this broadcast. Remind you that November is elections, and get out the vote. That's one of the things that the League strongly endorses and encourages. And watch for rebroadcasts of this program on your local cable TV. Thank you very much.